Foreign investors gain from cheaper dollar hedges as Fed resumes easing. Foreign investors gain from cheaper dollar hedges as Fed resumes easing. The Federal Reserve's recent decision to cut interest rates has opened up fresh opportunities for foreign investors. With the Fed lowering rates by 25 basis points to 4.25% in September 2025, the cost of hedging U.S. dollar exposure has declined significantly. This shift makes it easier and cheaper for global investors to protect themselves against currency risks while holding American assets. Why hedging matters. Foreign investors often buy U.S. stocks, bonds, and real estate, but they face a critical challenge: exchange rate risk. If the dollar weakens, their returns in local currency can shrink dramatically. To avoid this, they use hedging contracts, essentially insurance policies against dollar depreciation. When U.S. interest rates were much higher than those abroad, hedging was expensive because investors had to pay a steep premium. But as the Fed cuts rates, that premium shrinks, lowering costs and making hedging far more attractive. Current trends. The dollar has already weakened by around 10% in 2025, partly due to increased hedging flows. European investors in particular are boosting their hedge ratios, taking advantage of more favorable conditions. While the environment has improved, hedging remains costly for Japan and Switzerland, where ultra-low domestic rates still create wide gaps with U.S. yields. Broader implications. 1. For the dollar. If more investors hedge aggressively, it could add further downward pressure on the U.S. currency. 2. For U.S. assets. Cheaper hedging may encourage more foreign buying of American equities and bonds, since the currency risk is easier to manage. 3. For global markets. A weaker dollar typically eases financial conditions worldwide, supporting emerging markets and boosting global trade flows. 4. For policy. The Fed's easing cycle signals not just relief for U.S. borrowers, but also a structural shift in international capital flows. Why this matters for emerging economies, like Pakistan. Export competitiveness. A weaker dollar can raise demand for exports priced in U.S. dollars, including textiles and raw materials. Debt relief. Countries with dollar-denominated debt may find repayment slightly easier as the dollar softens. Capital flows. Lower hedging costs could redirect global investment flows, making markets outside the U.S. more attractive. Outlook. If the Fed continues its easing cycle, hedging costs could fall even further, strengthening this trend. For foreign investors, the environment is becoming increasingly favorable. For the dollar, however, the pressure may intensify, keeping it on a weaker path through 2026. In short, Fed easing is not just about U.S. households and companies, it's reshaping global investment strategies.